Welcome to MHN Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. Today is our mid-year outlook for multifamily investment. I'm Suzanne Silverman, editorial director of Multi-Housing News, and our expert panel today includes Jeff Adler, vice president of Yardi Matrix, Joanna Zabriskie, president and CEO of BH Companies, Marcus Duley, Chief Investment Officer of Walker and Dunlop Investment Partners, Hilary Province, Executive Vice President of Production and Capital Markets at Berkadia, Tyler Griffin, President of Mortgage Banking at Lument, and Brett Fawley, Director on CBRE Investment Management's Insights and Intelligence Team and Head of America's Residential Research. We're recording this session, and it'll be available for later viewing. In addition, we're going to leave some time at the end for questions, but feel free, please, to submit them at any time during the webinar. Don't be shy. And thank you to those of you who submitted some in advance. We'll try to get to as many as we can. Jeff is going to start us off with a database presentation, and then we'll go into a discussion of the issues in more depth. So Jeff, I'll hand things over to you.
Well, thank you, Suzanne. Thank everyone for being here today. Let's go to it. Okay, so if you think about kind of where we are right now in the sort of cycle, and this is just looking at rent changes on a sort of a monthly annualized rent growth basis, we're kind of at the back end of a cycle. We had, pre-COVID, we were sort of running along at a 3-4% rent growth. It was turbocharged in the pandemic through the movement of people. We've now had a slowdown in the movement of people and a significant supply surge. And quite frankly, where we sit today, plus one-ish kind of annualized growth rate across the entire country is actually pretty good in the face of historic new supply. And it is bifurcated absolutely by market. Now, if we kind of go and just think about this on also from an occupancy standpoint, occupancy is in the sort of 94-ish range. It's been giving a little bit of ground as the new supply has kind of come in. Absorption, though, has been very, very good. And so we're, again, at a point of, relatively speaking, results are pretty good, given the amount of supply that has hit the market and has been absorbed. Now, if you kind of go this on a market by market basis, and this is the kind of story, this is April's numbers. Actually, I just got May's numbers last night, not yet for public distribution, but I can give you a little window onto that. You're seeing at the sort of on the positive end, places in the Northeast and the Midwest that didn't have a lot of supply and have had, some ongoing, continued job growth and support from very high home prices. Those rents are still growing. And on an annualized basis, 3 to 4%, actually pretty darn good, again, given where we are. The ones that are at the sort of right end, where you're seeing negatives on a year-over-year basis, is just very high supply markets. These are dynamic economies, absorbing new supply, and that supply is getting absorbed, and price is giving way in order for that to absorb. But that's not kind of, quite frankly, of deep concern. As you look kind of forward, and as we look forward, and this is annualized expected new supply deliveries in multifamily by the segment of the product, you're definitely seeing, 24 was the peak. We're seeing still a lot of supply in 25 come on board, but then it basically steps down to 27. 28 to 30 is kind of a bit of a wild card. Just because of capital market conditions as well as raw material conditions. So I don't think that it goes, much below 300, but that's not enough to resolve the housing shortage that we have. We would need something like 450,000 multifamily and 1 million single family to resolve the housing shortage over something like a 4, 5 to 10-year period of time. So 27 and 28, we're looking like we have another upswing in rental growth. Again, and that would be kind of targeted at the high supply markets because that's where the big decline actually is. Now, just for historic perspective, this is the amount of supply that these markets have already absorbed and survived. And that is actually quite astounding. So this is over the 22 to 24 period of time. That's a lot of supply. There is, in these markets, a fair amount of new supply yet to be absorbed. And this is across, again, all product types within multifamily. It is a fair amount that needs to be absorbed, but it is getting absorbed. And if we look at just again for May rent growth purposes, which I just got last night, it was a pretty decent month on a sort of a seasonal basis. There was uptick in a lot of the or stability in a lot of the Sun Belt markets, a lot of continued growth in a lot of the Northeast and Western markets. Actually, San Francisco kind of coming back to life, the Bay Area, Seattle, some areas of Portland. So, performance is actually pretty good everywhere. There's only a few markets that have sequentially saw rent declines. I think it was Phoenix or maybe even Tampa a little bit, but Tampa had been performing quite well. So the market overall is actually doing on a fundamental basis pretty well. Now, on a transactions are up in the first quarter relative to a year ago, but still quite muted compared to kind of, 21, 22, before rates really kind of popped at the beginning of 2022. So what I'll do here is just sort of highlight to you that there are, a series of ongoing strategies as we kind of turn it over to the rest of the panel. The core markets are recovering. Office is struggling, obviously. There are conversions going on in those markets, but Chicago's doing well, Boston's doing well, Manhattan's been doing well. The Bay Area has basically got a little kind of signs of life. Philadelphia is doing well, so that area in the emerging tech hubs and manufactured value add hubs, there is a lot of new cities, smaller cities in the sort of a non kind of traditional Sun Belt and Mountain West markets that are been growing. They haven't a lot of supply. There's reindustrialization happening, and they are performing quite well. And then we have the large high supply markets in the Sun Belt and in the sort of Mountain West, the Denver, Salt Lakes, Phoenix of the world. They are absorbing this supply. They are dynamic economies. They will be the ones that kind of bounce in 27 and 28 as that supply gets burned off. Anyway, so that's kind of just an overview and a bit of an introduction. And I will stop sharing and turn it back to Sue.
Thanks so much, Jeff. That was a great introduction to our conversation. Got some good data there for us to talk about. So as we jump into the discussion, Hilary, I'll start with you, and I'd like to just review what each person sees as our biggest concern, as your biggest concerns, and then we can delve into them a little bit more.
Sure, I'm happy to start. And I guess, what we're seeing on the capital market side from a transaction flow standpoint that Jeff kind of showed with that last slide, not getting back to more historic norms, as well as kind of financing, what's driving the challenge in that market is honestly just volatility. And the volatility we've seen on it from an interest rate standpoint. If you look at the data from the last, year, so if it's 250 trading days, we have had a quarter of those trading days, interest rate swings between 10 and 20 basis points on the 10-year, a quarter of those days. So when you're having that level of price volatility on our base interest rate, the 10-year, which is what we price most of our deals off of, it's really hard for investors to get comfortable relative to where they're willing to commit from an interest rate standpoint. The other thing is you obviously have, and we can get into this later, the political uncertainty and volatility that's created in the market that's driving interest rates up. And if you had that volatility probably closer to a 4% 10-year, that would really be a different dynamic than the 4.5% 10-year. So that 50 basis points, like it was Katie bar the door when we were like hovering around a 40, but with 10 basis points, 20 basis point swings. Now that that upward interest rate pressure towards a 4.5, potentially leading towards 5, is really creating that dislocation. And the biggest issue in my standpoint on the transaction activity financing market.
Okay, thanks, Hilary. Joanna?
Same theme applied a little bit differently as Hilary. So volatility in the macro economy and how it impacts our consumer. So tariffs, immigration, inflation concerns. First quarter, we were really worried about consumer sentiment and how that would impact leasing. We doubled down really on occupancy over rent growth, and our motto was 95 by July. And we're in the high 94s, as Jeff mentioned. We're in the high 94s right now, so it's working. However, it's been a really slow start to the leasing season. The past 3 weeks, though, we've seen a glimmer of light. We've seen traffic and applications pick up, and it feels like spring leasing season has finally arrived. And so while we're cautiously pushing new lease rents, renewals remain extremely important to us as we tiptoe through this really choppy economy right now.
Okay, thanks. Brett, did you have some?
Yeah, I mean, I
thoughts?
would just echo volatility. I mean, I can't say it any better than Hilary Joanna laid it out there. And I guess I would just add on to that negative leverage. So, that's one thing. If there's one thing that keeps us, especially from a research perspective, be up at night is, how long can this negative leverage persist for? I know that there have been decades. I mean, it's persisted in the past for an extended period of time, but really just how long can that go on?
Okay, anybody else have anything to add?
Yeah, I mean, I don't know if I have anything to add. I'll just echo the volatility, and what that really represents is the uncertainty. And a lot of that uncertainty is driven by uncertainty around federal policy, particularly with trade, tariffs, trade war. And so you've seen the market move in flux with almost feels like daily with news coming through in terms of, tariffs, for example. Just recently we learned that the tariffs are off again. There's a
some
court
of them
ruling.
are.
What does that? Some of them off, right? The blanket tariffs. What does that mean? So it's that uncertainty that's causing that volatility. Again, as people on the panel mentioned, volatility in the 10-year Treasury. That has an impact on transaction volumes.
Yeah, volatility has been big for us as well. Also being a lender, but I'd be curious, Joanna, as an owner, what you're seeing too on the operational side, because we're actually, as far as biggest concerns, we have a lot of institutional owners, but we also have a strong middle market ownership group. Those with maybe 2,000 units, and they're spread either kind of regionally or across the country. And from an operational efficiency standpoint, they're kind of being pushed out, particularly when you look at things like insurance. So that more smaller ownership, we're seeing less of, which is I think leading to some consolidation. But I'd be curious if there's any other operational issues too that you're seeing from that side.
Well, we're also seeing consolidation of management companies throughout the industry because it is harder without scale or operating efficiencies to really drive down those expenses. The back to volatility, how do you predict what a turn cost is going to be fourth quarter, because you don't understand how tariffs are going to impact what goes into a turn or what goes into a renovation. And so budgeting this year is going to be a real treat, not understanding, where the expenses are going.
Right, Joanna, I would be interested, as mentioned before, from the data, it appears as if, there's a fair swath of consumers that are under some level of financial pressure. You've got rising auto loan delinquencies, you have rising credit card delinquencies, you have some rising student loan delinquencies. And so I wonder, or I'm curious, are you seeing any of that show up in your numbers, or it's just not translating through to the renter base?
Not yet, and we're watching very closely for it. It's interesting, our approved applications were relatively low due to higher levels of screening, obviously. Right. But we've just seen them over the past maybe 3-4 weeks tick up to 70% approval from a much lower number, somewhere in the 50s to 60s. And so we think that leasing season is bringing out people that potentially might want to buy a home and are more economically stable, but because they are priced out of that home and interest rates are so high, that we're getting a stronger renter economically. But we are definitely on the watch for any inflation, any job losses. We had good jobs postings again. So right now it's pretty stable, knock on wood.
And I mean, the data as it relates to retention rates are very high.
Very much so.
Rental achievement on those renewal rates are very good.
They are.
even in places that are absorbing a fair amount of supply. One of the things that's enabling that supply to be absorbed is the reduced turnover and availability of units. So that actually, the higher home prices and, again, paradoxically, higher interest rates are keeping multifamily properties, relatively performing well. And on the single family rental side, that performance of that market has been pretty decent. It's tied to multifamily rents as well, but it has done quite well. So there seems to be some kind of bifurcation between the fundamentals and maybe the transaction market.
But I also think you have operators who have centralized renewals and
Right.
focused on that renewal being very important. I know we have prioritized the renewal over the turn because turn costs are increasing,
Right.
and renewals are gold. So if you take an operating function off of site and you focus a team of specialists on it, renewals are going to improve, and that's just a fact. And I also think consumers have their hands in their pockets right now. Consumer sentiment's low, and when people are scared, they don't move. They don't make a decision to spend more money or to move. And I think all of those factors have really bled into renewals and retention being higher.
So, Joanna, we talked about operational expenses impacting management companies, consolidation among management companies. What about on the investment side? How much is it impacting smaller, more regional owners' ability to compete in the investment market?
It's tough. I mean, the obvious answer right now is that profits are compressing as expense growth outpaces rents, especially in the Sun Belt. For the last several years, insurance, you mentioned that, Jeff, has been really impactful on the underwriting of acquisitions because of the sharp increases. But this year we saw a decrease in property insurance, thankfully, knock on wood. What we're finding really interesting now as we're underwriting deals is the impact of centralization programs on the P&L. We're used to scrubbing GLs and to find those gift cards that are used for instead of concessions, all the usual tricks. But as different management companies centralize different functions, it's a challenge to figure out, what's been centralized, what staffing has been removed, and what's charged back for that centralized services. So we're, at BH, we're relying even more heavily on our own best comp, which is our expenses per unit. But you're really seeing the operational landscape change between some of the bigger management companies and the smaller ones and how they are managing operations. And I think that's a dynamic that's kind of fresh to the market right now.
Thank you. Let's talk some more about the price volatility. Brett, how do you see the bid-ask spread trending now? Do you see a trend now?
Well, no, it's a tough question to predict the future, I would say there. But I want to be clear, there is a real bid-ask spread today. And we're on both sides of it. For a high quality opportunity that we want to buy that's trading below replacement cost, sellers want sub 5% cap rates. And deals are clearing at that level. And we're seeing it in real time. A recent example was in Atlanta, but another market that might surprise people where sellers are asking for the stars and the moon is Madison, Wisconsin.
Mm-hmm.
It's a small, tightly held market where owners have a lot of leverage.
And performance is actually quite good.
Exactly. And it's a market that, a lot of institutional investors might like to get into. And then the buyers on the other side, I would say, all want something with a 5 handle. So back of the envelope, that's about a 25 to 50 bid-ask spread. And I mentioned negative leverage at the top of this, right? I believe last I heard, and someone please correct me if I'm wrong on this, I think it was neutral leverage right now is about 5.2 to 5.3% cap rate. So, that's kind of the bogey of partly what's creating that spread there. Where does it go from here? I think if the gap closes, it's going to have to come from the sellers, personally. The rate volatility that we've talked about so much, the high borrowing costs, the need to find accretive cash flows for core strategies should keep a floor on the bid, at least from an institutional perspective. Meanwhile, right, you do have closed-end strategies and developers that have been patiently waiting to maximize their exit proceeds, but in doing so are just watching their IRR tick down by the day and would like to recycle that capital eventually. So debt maturities are another motivating factor for some would-be sellers. Though if they're in a place to be able to negotiate an extension, they can still be picky in accepting offers. So put all together, I say overall, I expect the bid-ask spread to persist on average near where it is, unless sellers really become motivated to recycle capital for their next endeavor.
Right, Brett, what I had heard, and the other panelists could discuss this, what I had heard at some of the most recent conferences was that not a lot was coming to market unless it had to. It was being pushed by a debt maturity. And there was a bifurcation in the market where if it was a high quality asset, even if it had a loan maturity, because there's not that much coming, right? The
Yeah.
competition was pretty fierce. But if it was a lower grade asset in the same circumstances, that's where there was just not a lot of buyer interest for that. And I wonder if you guys are seeing that in real time. Is that true, not true? And what would your take on
Yeah.
that be?
Yeah, it's definitely been the theme for a while now, right? The haves and the have-nots. It's either trading sub 5 or it's trading,
No
what
bid.
no bid.
No bid.
Yeah. So yeah, I mean, and that's partly what's driving that bid-ask spread, right? Because like as you said, the pool of actual high quality assets that you want to buy is limited. And even if there is a motivated seller, there's enough buyers on that bid sheet that the stress is not leading to discounts. Let me put it that way.
Okay.
Yeah.
Yeah, I'd say we talk about the haves and have-nots. When you look at the have-nots, you're really focusing in that sort of Class B space where we've seen cap rates in that 5.5% to 6% range. We've seen actionable opportunities where we're buying 80s vintage or have the opportunity to buy 80s vintage at with positive leverage. And so when you have the haves and you have that sub 5 cap rate, that's really where the market is really tight. And the opportunities, although be it with greater risk, are really in that Class B 80s to 90s vintage. Our investment sales team puts together some information that goes across the company that we can use. And we talk about sort of seller motivations within their pipeline and what we've seen in terms of that. 17% for sellers are motivated to sell are based on merchant built. So these are developers that built, they've basically leased it up, stabilized, and they're moving to sell. 24% has been from debt maturities, what we mentioned, or also amortization. So debt's coming due. As an owner, you have to make the choice whether you're going to refinance and potentially put new money in, or are you going to sell, take maybe a lesser profit and redeploy that into a better opportunity? And then 44% has been what we're calling strategic or performance driven, where a seller needs liquidity issues. They want to recycle capital, perhaps that the property or the asset is underperforming, or the value add business plan has been complete. And what we've seen in our investment sales team as well, in terms of pipeline in 2024, our investment sales team had $9.7 billion of transaction volume. Pipeline right now is about $16.2 billion of transaction volume. So that's about a 75% increase. So we do expect transactions to pick up. I think that bid-ask spread is narrowing a bit. And also what you've seen in terms of properties that we as investors in multifamily properties at WDIP, we're going to market with a certain expectation and working with our brokers. And so it's whether or not we're able to hit the bids that our brokers has advised us on. And so again, what we're seeing is in the areas when our Class B properties, we're falling just a little bit short, kind of in that 5.5 to 5.75 cap rate range. And again, the Class A stuff, you're falling kind of 5%, slightly below 5% cap rate range.
I think that's a really good point on the developers as well, because that is also definitely where we're seeing some opportunity is on lease ups. Something that's still in lease up. You're maybe taking a little bit of lease up risk, but you have a developer who's ready to sort of move on to the next project, as you said, Marcus.
Or equity pushing that developer. I think we're seeing it even more on the equity side, pushing even if the developer wants to hang on, their equity is kind of forcing the sale. as well. And I would just, I can chime on to Marcus's pipeline. Our pipelines are equally as large relative to this time last year. I think one of the interesting dynamics we've seen recently, and it was really even in this last month, the shift when right after Treasury rates shot up again, post tariff and announcement, we saw a huge shift, about $5 billion from our investment sale pipeline to our debt pipeline.
Okay.
And it really was a testament to how, and you mentioned it, Jeff. I think borrowers are basically looking at refi, recap, sale all at the same time, running the math, and then trying to do I see upside? How am I valuing it based on my current bid today? And the debt market is so liquid right now, and the bridge market is so aggressive that what we just saw a huge shift. And it's easier when you have Treasury rate volatility to lock in a debt quote than a sale when negotiate a 3-month PSA. So I think we saw this $5 billion shift to bridge to sale, basically from April to May. And I imagine that trend, if you can hold on and you do have that optimism about the future, you're going to try to.
Our pipeline did the same, Hilary. I would speak though to the balance sheet in particular, from what Brett was saying and Marcus too, of what's available. I mean, in 2021, 22, we saw all the debt funds and balance sheets financing value add. Those are coming up, and what's available for sale, what's coming out of it, is the stuff that didn't finish, right? The business plans that didn't quite make it. Now getting on the market if there aren't a lot of other recap options. Otherwise, what we're financing today is less of that and actually more of the lease up that we're seeing come out that the sellers want too. So it seems like we're all kind of chasing some of the same things.
It sounds like, from what Marcus said, is the value add, the older product is where the sort of the pricing is the weakest if you were a buyer, right? And so, would you be leaning into a sort of value add opportunity to go there? But if you're not in the Sun Belt, right, you still have rising rents all over the Midwest, and so those are deals that could make sense. Or you're betting in the Sun Belt, basically for a semi-stressed situation of something that was bought at the peak with variable rate debt, and things just didn't work out. There's been a select number of deals that went sour, like in Atlanta, in Houston, a few. Not again, more dribble than river, right? It's more like a little trickle than anything else.
Yeah, no, that's definitely a strategy that we've been putting a lot of thought into, especially because of some of the things that we're seeing on the other side of it. I think probably the most interesting thing there, especially in that older vintage value add stuff, is that a lot of the traditional players, from what we can see, are kind of dealing with their own issues on their own books right now. And so they're not necessarily your classic typical buyer for that product, maybe isn't out there. So then does that create an opportunity for others to again, as Marcus said, that is the product that's pricing the best.
Yeah, and it's a reflection of, flight to quality at the end of the day. You have less CapEx issues. Everyone likes the shiny new nickel. Presumably you have a better tenant base as well. So that flight to quality is keeping cap rates, relatively tight, for those Class A properties, and also widening cap rates for those Class B properties. But there's still a lot of opportunities. The challenge is when we're looking for deals, there's a lot of bad deals out there as well.
Right.
So,
but you're certainly not going to get rent growth near term, right? In a lot of those upper end. So is really the bet is 28, 29, there'll be a bounce back, and that's where you'll benefit from.
Yeah, the bet is you don't need rent growth at a near term, right? The bet is usually over at least a five-year hold. So you're looking out through that. In certain instances, when we're underwriting for new deals, we're looking at actually, for a value add deal, maybe the value add doesn't start until 12 months out, until some of the supply has been absorbed, and you can really calibrate. It's interesting though, because you're looking at you're looking at rents that have gone backwards. So how do you go
Mhm.
forward after you've gone backwards when the rent roll is turning over to the
Right.
negative, but you still think that you're buying at a decent basis or a decent yield? So that's some of the challenges as well in terms of underwriting, particularly in these kind of Class B, 1980s, 1990s vintage properties.
And what Marcus, what you said about bad deals being out there is a really important point, because I want to be clear that not all of these assets are valued at their loan basis. There is some actual real distress out there on loans that were underwritten to, we were talking about the business plan wasn't completed. They were underwritten on an LTV to the projected stabilized value. And that's how you get some underwater loans. So you do have to be careful. You can't just assume, hey, it's apartments. If I could get it at the loan basis, it has to be a good play. You have to
And that's a new
Music to my
phenomenon,
ears,
though.
Brent, because I just passed on a deal that was, that was being pushed. It was we could buy it at the loan basis. But when you look back, that loan basis was actually 2019 basis. So we just reverted back to 2019 pricing at the end of the day. And I'm not a huge basis guy. I'm more of a yield guy. I mean, basis is good. Everybody says they're buying at a good basis. I've never heard anyone say I'm buying at a bad basis, but I really look at cap rates and yield. So am I going in at a really good going in yield? Is the pricing, representative of the risk, and overall, where's the market direction going? So, but everybody says I'm buying at a good basis. I can buy it at the lender's basis, so it's a good deal. Maybe not.
But that's also a new phenomenon, because I mean, we did the same thing everyone else did. We've been extending. And in the loans that are not looking good, it was all right, well, maybe we're going to get some rate relief and something's going to work again here, or they'll be able to raise more capital and it's going to work. That music finally stopped. And you can kind of see that around. You're starting to see some of that coming out at okay, well, you can buy it at par, you can buy it at 5% or so below par. And I think you'll see some distress as we get further into that part of the cycle, but it didn't happen until really quite recently.
And I also think people are trying to sweep it under the rug. No one wants to advertise their distress. So you're seeing seller financing and like kind of off-market deals to solve the problems that aren't being advertised publicly. So I think a little more of that's happening, but it's happening, to your point, on a one-off basis. It's just starting, and you're trying to do it a little more on the, under the cover of darkness rather than making people aware of your distress.
And Hilary, that's an interesting comment, because what we're seeing across our portfolio is that lenders are quietly taking assets back, and they're keeping us on as the management company.
Mhm.
So that never used to happen, right? You'd always get rid of the management because it was their fault that the asset got in. But I think there is an acknowledgement that, hey, the assets are not valued at the loan amount, and I'm not ready to give them up yet. They're being operated well. We'll just carry it for a little while and see what happens.
So that more of a sense of that the financial structure is a problem, but
That's
not the
exactly right.
fundamentals of the property itself.
Correct.
It's just poorly capitalized.
Or the prop was overpaid, right? Overpaid when you
right.
bought at the peak. So, a Class B property that's traded at a sub 4.5 cap, as we mentioned, now is 5.5, 6 cap. That's a lot of value diminution, and there's really nothing you could do as an owner operator other than if you finance with floating short-term debt, other than capitulate or try to hang on until you can hopefully grow NOI enough. But that's a lot of growth.
And if you're talking about buying at the peak 21, 22, in a high supply market, well, rents are off the peak quite significantly. They're still up relative to pre-COVID levels, but again, if you bought late 21, early 22, then you're definitely operationally also going to be underwater compared to there where you were there.
So let's talk about financing strategies. And just a reminder to the audience, please feel free to submit questions at any time. We'll be going to Q&A fairly soon. This discussion's going pretty quickly.
Yeah.
We've covered a lot of ground. I'd like to talk a little more about financial strategy and for the financiers, how you've changed how you evaluate investors' financial strength and track record, and what criteria you're using. And why don't we start with that? Tyler, I could start with you on that.
Sure. I mean, you mentioned track record. I think track record's always been important as a lender, of course. But in this part of the cycle, it became the most important. Who's been through a cycle before? Who has the investor base and stable that knows how to has the wherewithal to handle the cycle, right? We saw a lot of not only syndications, but we just saw a lot of people getting into the business that hadn't really been able to withstand a downturn, and they didn't know what to do. So they immediately turned to, here's your property, have fun. Knowing that someone has a plan B and C is becoming more and more important. I think also the way that we're looking at repairs has changed through the cycle. CapEx is, we've been talking about, it's more expensive, and those that don't have the correct CapEx in place, those properties are the ones that are on the blocks right now and being sold, and those business plans have become more important as well. So stable track record. If you're getting into the business, we're still interested in those deals as long as you do have the investor wherewithal and the base behind you to get the property to stabilization.
Joanna, you're nodding. Do you have anything to add to that?
No, I think Tyler did a
Okay.
great job.
She
I
summed
was
it up.
agreeing with her.
Okay. Hilary, what financing strategies are you most comfortable pursuing in today's market?
I mean, I think what we're seeing, and I agree with everything Tyler said, it kind of is a little of a corollary to what Joanna was saying on the management side. The big are getting bigger and the strong are getting, if you had the wherewithal and experience to weather a cycle, that expertise is valued even more now. I think we see it on the fundraising side as, you look at even the largest private equity funds growing even bigger exponentially relative to their peers. It's really hard for some of the middle market private equity funds to raise capital right now. And so I just think, and then on the newer sponsorship, one of the great things about commercial real estate and multifamily specifically is how diverse and fragmented the market is, and it has been for decades. That being said, there are significant economies of scale for managing properties and doing it well. And people are learning to use technology and to use their teams to take advantage of it. And I think you're seeing that market consolidation being advantageous relative to financing. Now, that being said, there is so much debt liquidity out there right now that anyone can get a loan at some price just because there are so many lenders. I mean, that's the great thing about our segment too. You obviously have the GSEs who have always been kind of the basis, but CMBS and SASB are super liquid right now. Life cos have more capital than they've had in a long time. And then the banks are not only lending directly again, but they're the ones basically fueling the debt funds because they're providing all the back leverage to Apollo and KKR and Blackstone, who've raised all of these credit funds who are lending at, 7% debt yields on bridge deals. So I don't think I've seen this much liquidity from a financing standpoint since, the go-go days of the 2000s.
2006, yeah. The banks, Hilary, you mentioned, I mean, we've seen spreads on banks, if they're lending directly and they like you as a client, 150 or below over for floating rate. I mean, you can't compete. Life cos have been more competitive, but I do think their spreads, especially relative to agencies, and in the past, life cos have been able to get inside agencies. I think they've had a harder time as of late. But the banks are certainly winning the day right
now. And the life cos, I mean, they're playing to their strength, which is I'll get into a lease up deal at 20% occupancy or even C of O, depending on the deal, if they really like it.
Yeah.
The other thing I would kind of maybe highlight that we haven't really kind of touched on as it relates to what Joanne's kind of dealing with is as a level of regulation around multifamily housing has continued to become more complex, more professionalized, larger organizations have the infrastructure to handle that complexity. It's not really what, from a public policy standpoint, I think the people pushing that legislation actually understood. But again, by making it tougher, they're actually, pushing consolidation in the management side because it's hard to do business otherwise, and it's making it more complex. I think it has been a strength of the industry that it is so fragmented, certainly from an ownership standpoint, and even from a management standpoint to a certain degree. But the public policy pressures are actually leading to greater levels of consolidation because the penalties for not complying are quite high.
And not only consolidation, but there's also places where you don't want to own or operate because of those regulations.
Right.
And the unintended consequences of those regulations is limiting supply and is limiting the willingness of operators to be there. I look at Colorado and they put a 2 times income law into place in August of 23, and as a result, we have to approve prospects that have 50% of their income, their gross income, is going to go to rent. And that is far higher than the 3 times normal, industry standard. And I think,
and I believe you're seeing it in increased delinquency.
Oh yeah, increased delinquencies and bad debt. It's bad for the resident. The outcome is bad for the resident and the operator. And the intended consequences were, we're going to make more housing available and affordable for everyone. And the opposite has happened in Colorado. So back to your comment on regulation, keeping abreast of the changes that happen locally and states and then federally, it's very complicated.
We haven't mentioned foreign investors or foreign players in general today, but earlier, somebody, Hilary, I think you brought up the political uncertainty out there and the volatility out there right now, world economic volatility. Has there been an impact on foreign involvement in the U.S. multifamily investment market?
I don't think I'll be honest, we haven't seen it yet. There's still foreign I think some of the damage we're doing internationally and from an isolationist, remains to be seen, but we have yet to see we're still seeing APAC, Japanese capital, Asian capital, really interesting. You've seen some big transactions and you're still seeing that level of interest. You're still seeing it from Europe. Let's be clear, despite all these headwinds, like Jeff talked about it, the fundamentals of housing in America are very, very positive, particularly the rent versus own dynamic that I don't think with higher interest rates we see shifting anytime soon. Everyone sees those and the dramatic undersupply we'll have long term, I think is still driving those investors to look positively. Let's keep watching it though. I don't know if anyone's seen any other indications.
Yeah, on the topic of let's keep watching, I actually did want to make a PSA about something that is just starting to get news. We just kind of learned about this coming out of the big, beautiful spending bill, which is this Section 899, where it would basically give the president the ability to put revenge tax on foreign capital invested in the United States. Basically, the idea is to create leverage to negotiate lower business costs in other countries. But we were just talking about unintended damage, right? Unintended collateral damage. If you're going to use investors' U.S. assets as a weapon, as a negotiating tactic, there's no way that's going to have a positive impact on foreign capital inflows.
You're right.
All right. So, Brett, if I understand that right, is that you could have retrospective taxes on the exit of capital?
Yeah, they can add a punitive tax on what was it? It's a tax on all passive income from U.S. assets owned by foreigners. Potentially, anyone from that they're targeting. Right. But at the discretion of the president to decide what is quote unquote unfair tax policy. Gotcha. They're really going after the corporate minimum tax and the digital media tax. But so countries that have a digital media tax are the UK and Canada. Right. There's a long list of countries that have a global minimum corporate tax. But I do want to be clear before we all start panicking. I just want to make sure everyone's aware of this because has come to our attention and does seem important, and voices need to be heard on it, because this is still right. The bill's still in the Senate. This is not the final language of the bill. This is
Right.
definitely something that hopefully will not make the final bill, but it does point a little bit to some of the thinking around the capital account and the fact that they could start targeting the capital account for taxation.
Right. From what I had heard, to the extent that there was the Canadian capital was still coming to the United States, though there was one or two Canadian funds, kind of more, public pension funds that were that put a little bit of a pause, and that in Sweden and Germany, there was some pause in capital. Elsewhere, it was kind of business as usual. And I haven't heard anything over the last 4 weeks, whether that was just a pause and then things are back to normal, or it was a longer pause. And obviously, I think the Chinese capital, in my mind, had kind of dried up several years ago. That capital flow is not coming to the United States and hasn't been for several years.
Yeah, I mean, I would say we've seen some impacts on capital flow, and kind of to your point, a lot of it, if you think about where the trade negotiations are sort of going, that's roughly the correlation of how different countries are thinking about investing in the US. So to the earlier point, yeah, APAC is strong. We're seeing a lot of interest from Australia. I think momentum in the Middle East is really strong. So there's some positive momentum, and on the other side of the coin, I'd say, yeah, you are seeing a little bit, maybe a trepidation from some Canadians, not all. Money's still coming through, to be clear, money's still coming through. But to your point, like Germany, Europe, I would say they're probably, I mean, if you think about what's been said in public in the trade negotiations, that's probably sort of where there's a bit more contentious.
I would also
Yeah,
differentiate between institutional capital and high net worth capital internationally. I think we're seeing a huge spike in high net worth international capital too, just because they want long dated, like the asset liability matching is strong for.
Right. And it is important to understand it. Oh, go ahead, Marcus.
That capital, I think we're mostly focused on direct capital, but that capital is also indirectly coming in through closed-ended funds as well.
Right.
So there's still a lot of foreign appetite to not own directly, but to own indirectly through institutional funds.
I mean, I think it bears some mention that there are not many places in the world where investors can get access to residential housing at all. Okay, so there's just not that many. It's not a developed asset class in most of the developed or even developing world. So even in the UK, there's barely a rental sector. In Australia, barely a sort of professional rental sector that one could invest in. So that's one of the benefits to US multifamily housing, and even institutional SFR housing, is just there isn't many other mechanisms globally for investors to invest in this asset class except for the United States, and we've been a big beneficiary as a result.
Yeah, couldn't agree more.
So we're getting toward the end of the webinar. We do have quite a few questions from the audience, so I'd like to turn to some of those, and then if we have time, we can have some closing comments. The first question I will throw out there is, do you see big variances across the country with loans coming due for many at this 5-year point?
I mean, help me understand, Sue, do you mean in terms of like problems with financing those loans coming due?
I think so.
Okay, so maybe Hilary and Tyler might give us some insight.
It goes back to that point. We haven't really truly seen the distress yet, but it really ultimately ties to asset level performance, and where you're seeing more rental challenges and occupancy challenges is where the financing mismatches are happening. And I think Tyler said it well, like I think we're expecting to see more. I don't know if you want to.
Yeah, we're expecting a little more. There's not going to be a flood. But where we're seeing it, yes, it's in the markets that are oversupplied, but it's with ownership that probably didn't have the experience they needed. So
Right.
it's really, in our minds, more of an ownership issue. It's not a fundamental market problem. And it's even in those absorption areas that need to be absorbed, it's still not an issue there. It's not a long-term issue. That's why you're not going to see a flood, because as lenders, we're happy to keep working on those as long as we have a borrower who's able to recap, or even if we take them back, we'll wait and we'll work through them and wait for
Yeah.
the market to come back.
I mean, we had sized up the size of the issue. We were looking at the number of loans where they were bought at the peak or issued at the peak with variable rate debt, with properties in markets and submarkets with declining fundamentals, and it was about 6,000 to 7,000 properties in total, and that was of all kinds of all sponsors. And then if you kind of cut it down to kind of the sponsors that were kind of newer, it was a couple thousand. So again, and we track 125,000 properties and 23 million units. So if you talk about a couple thousand out of like 125,000, it's a thing. It's just not a sort of a huge thing. I think
Yeah,
I think that's kind of what you're seeing.
That tracks exactly what we're seeing on the ground. We've seen a trickle of deals coming in from lenders that were poorly located, and the prior value add proposition could not have worked, right? There would have been no way to lift rents to a significant level to make that deal pencil. And those are the deals that we've seen with the kind of the syndicated equity, the floating rate, all that story. But they were also in locations in submarkets that were, you couldn't lift them, right? You can turn around an asset, but you can't turn around a submarket. And so we're seeing these assets that, should have stayed C assets, never really were ripe for that turnaround or that value add B lift. They should have just been kept clean, safe, and functional, and not had this grandiose vision applied to them. So that's what we're seeing. And it's a trickle. It's not a flow. It's not, a tsunami like we talked about earlier in the cycle.
I think
Go ahead.
I think important perspective too is that CMBS maturity wall that everyone was scared of post GFC that just never really seemed to materialize. In central banking as lender of last resort, there's a saying that you bail out the illiquid but not the insolvent. So where there's I mean, I think what we're all saying, right, is there's still a lot of solvency. It's more of a liquidity issue than a solvency issue. And so that's why I would expect, just like that CMBS maturity wall, it will kind of slowly all get worked out, and we won't see some big tidal wave come. But yeah.
Hey,
Which is different than this.
Go ahead. Was somebody saying something more?
Yeah, no, go ahead, Sue.
Okay, so all that said, we haven't really talked about the potential for recession, but I have a question here. How does one find the best off-market deals in recession potential times? So I guess taking that possibility into consideration.
Yeah.
Be good to
I
get
would
your
I would
thoughts.
just kind of say, look, you pretty much need some mechanism, either a set of brokers or some data service, right? Where you're basically, because you're looking for proverbial needles in the haystack, right? So it's because it's not everywhere, it's a few places. And so you've got to basically have some resource that helps you find those particular needles in the haystack. And you can find them through human relationships of the people local to the market. You can find them through various data services. And then you have to sort of pre-underwrite them and then start talking to people. And it's a lot more work. It is again, speaking to a lot of our clients, the ones who are successful at doing this have the infrastructure and the patience, right? They say, well, look, if I'm getting incoming OMs, I'm doing 100 to 1. And so, okay, I have to do that. But if I'm going to create my own pipeline, proactively, I'm going to have that same 100 to 1 kind of effort. And it's just a different kind of effort. And there are some folks who have been quietly successful doing this kind of work. But there's a lot of outbound work because, often the answer is no. You go ask somebody if they want to sell and they say no. And a lot of people say no, or they say no, not now. And so those people who are successful in building an outbound pipeline just have to get used to, being told no a lot, and then waiting and hanging around for the situation to eventually develop. And you can't tell when that will happen because it all depends upon all the other circumstances not panning out.
But how
And so
many
no one can
Yeah,
tell that
cases?
for sure.
How
I'd
many?
add so off market is really, to Jeff's point, it's really driven by relationships, and in a lot of ways it's a long game in terms of when you reach out to that prospective owner
That's right.
and hanging around the hoop. And then you have what I call quasi off market, which is not truly off market. It's really kind of narrowly marketed, and oftentimes a broker is involved. It's just not widely distributed. Then you have market. I'd say that most sellers want a widely marketed deal, right, to get the benefit of better pricing. But sometimes, just for uh, reasons where you don't want to make public, we talked about a little bit about hiding problems or what have you. You want it to be more narrowly marketed. And then off market typically comes from relationships or less sophisticated kind of owners.
I would just add, look in Texas.
Yeah.
Speaking of Texas, will there be a multi-year hangover where fundamentals are slow to recover in large supply markets like Austin?
Well, Austin will take some time to recover. It's got a big supply to absorb. It's not doing horrible. I mean, just to be clear, right? It's still a dynamic economy. I know there was an article in the Wall Street Journal saying, the end is nigh. I don't see that to be true. It will take longer the larger the pipeline. And so we measure like how long does it take? What's the peak? When does it start turning around? And I think a couple other firms have done the same thing. And Austin will take a longer, but it will come back. Austin, for those of you who don't recall, but it always had 8,000 more units. It was always a great developer market and really tough to get rent growth, always, because it grew, year after year after year as an economy. But I think Austin really is more the corner case. If you look at Raleigh or Charlotte or any of the other markets, they'll be turning around or basically stabilizing. They're already not doing bad right now in the face of a lot of supply in the middle of leasing season. And I think you'll probably seeing, in a year and a half, rent growth in those markets. So it's just a question of, again, and I don't think anyone can say with anything with certainty because it does depend upon the path of job growth in these areas. And domestic migration has slowed relative to prior years, but it's still going on. It's just not at the same pace it was in 2021, which was ahistoric and was never going to happen forever. But migration is continuing in all of these markets, and I think they'll do well. Again, give it certainly mid to late 2026 and into 27, these markets will be growing again.
Yeah, I'd say that's generally our view is that, we're seeing in a lot of these markets evidence that we're at the inflection point already. I mean, there's still supply that needs to be absorbed, concessions that will need to burn off, all that kind of stuff. But I think, and again, there are some markets, Charlotte, Phoenix, are still hitting peak supply this year.
Right.
So some markets will be behind the curve a little bit, but there's definitely some that are, I think, maybe even as early as definitely by next spring leasing season that we expect to be showing some pretty solid momentum.
Yeah, I just add that, real estate is cyclical, so it's about where we are in the cycle. And
Right.
so we've gone through a period of building. I don't even think we've necessarily overbuilt, but maybe we've overbuilt. Absorption takes time. So if you think about where we're at in the cycle, particularly with Austin, we're just coming out of that, call it oversupply for that time period, but that's getting absorbed. And then when you look at construction starts going forward, that's tapered down.
Yes.
So that bodes well when you look out further, call it 2026, late 2026, 2027.
Yeah, we look at we have confirmed about 330,000, multifamily starts in 2024, and that was, if I kind of look at that number, is pretty solid. Look at that, yeah, 330 exclude the affordables of 80,000 starts, which basically kind of leads to what you would expect to see in 2027. So it's kind of locked in as to what 27 will look like. And that's, quite a step down from the prior years. And again, this year, it's a little, there still starts happening, but at even a slower pace. So 28 does not look like a great year if you're concerned about sort of housing supply. If you're, as an investor, that's actually kind of probably a pretty good thing.
We're pretty much out of time, but let's just leave the audience with a few final thoughts. Maybe we could just go around quickly and give us like a looking ahead, your biggest concern and the biggest bright spot you see. Brett, do you want to start?
Sure. I mean, I guess, we've been talking about what's supporting all this rental demand, and I would just point out, the cost to own a home's up 100%. The cost to rent is up 20 to 30%. I mean, that's
Right.
over the last 5 years. Cost of rent's up 20 to 30%. The buy to own decision or buy versus rent decision's never been easier. And I think that's a big part of what's supporting the absorption and the recovery and performance that we're seeing. In terms of opportunities, I think where we continue to see a lot of opportunities is in recap opportunities, especially on our indirect side, because there you have GPs who are motivated to try to stay in the deal, stay in the assets in the portfolio. And so that's where we've been able to find, I think more attractive pricing, and close that bid-ask spread a little bit.
Okay, thanks. Who's next? Joanna?
We'll tell a little bit of good news. I think that the supply in the Sun Belt, while it was temporarily and is temporarily challenging for us operators, has shown that the way to bring down rents is to build more supply.
Right.
And that's a great lesson for our local and federal politicians. And that, Brett, to your point, and that supply also showed how much demand there is for rental housing in our country. As that supply is being absorbed. And I think that's a great fundamental underpinning for our industry.
Okay, thanks. Hilary?
I guess on the negative, what I'm most worried about is the macroeconomic risks, right? Like what ultimately will fiscal policy do relative to driving interest rates, relative to the risk of stagflation or overall rates just going up, which will have a very negative impact potentially on our industry. That being said, all the underlying fundamentals of our industry are really positive. So maybe those offset each other. And I also think some of the regulatory policy that the administration is putting in place relative to housing and multifamily can be really positive too. They want to get rid of restrictions around lending. They're trying to make it easier to do what we do because they recognize supply is important and housing is important.
Okay, Marcus?
When I think about concerns, again, it's similar to Hilary in terms of the macro, the volatility, the uncertainty, and ultimately how that filters down to jobs. At the end of the day, multifamily real estate to me is all about people being employed and being able to afford rent, afford housing, and so that's kind of my biggest concern, just the unknown there. But that being said, multifamily is a great space to be. We invest in not only multifamily, industrial, and others, but multifamily has always been really key. And I talked a little bit about cycles. I'm excited because where we are in a cycle, we're coming out of the downturn, right? The downside. And so going forward, when we look out to make our investments, I really see a lot of upside because of where we are in the cycle, because of the underlying fundamentals. Sure, there'll be some false starts. Not every deal is a great deal, but I think it's a great space to be.
Okay, Tyler?
It's policy on both sides. The volatility in the rates is driven right now from what our economists are seeing as well by federal deficit. We need to show in some way that we're controlling that federal deficit so that we can get stability on that long-term rate. And then for the positive, like Hilary said, we've seen positives out of this administration for housing. That's a great thing. If we can get some stability on rates, I think we're going to be in a much better position in the next 12, 18 months as we continue to move forward through this.
Great. And Jeff, give us some final thoughts.
There's a lot of great wisdom, among the group here. It's unlikely that we're going to see a dramatic decline in interest rates, long-term interest rates, absent significant progress on the debt to GDP ratio or even a bending of the debt to GDP ratio. If we do that, then that actually unlocks a whole lot of opportunity. One of the consequences of, as Brett mentioned, the spread between owning and renting is massive. And as a result, multifamily is the fundamentals of multifamily are very, very solid. And we do need to have an expansion of supply so that the industry continues to be vibrant and serves a sort of overall public good. Things in short supply forever don't lead to good decisions. And I'll point to New York City rent control as a classic example of a bad policy that was that for a while it looked great. You know, New York City, you could 10% of the units would turn over and you get these big rent increases, and it looked good for a while, but it basically fed a bad overall outcome, which is only now slowly where the chickens are coming home to roost. And we want to see a good balance, right, in housing. We want to see a supply. We want to see modest rent growth. We want to see modest, good, stable rent and value appreciation and volatility writ large, right? Even the big run up in 21 and 22 is not that great because of the sort of consequences that come down from that. And so I think we're looking for a way to have a nice mixture of good policy that creates abundant supply and allows the economies to grow and people to move and to form households. And I'm very encouraged. I think Marcus is right. There's choppiness here. But long term, boy, if you had to look at where would you want to invest in real estate long term, multifamily really is the place. We have our little problems here and there, but again, compared to all the other things that could be going on and are going wrong in the world, boy, this is a pretty nice place to be.
Okay, well, we are out of time. We'll be sending all of you a link when the recording's available. And if you enjoyed this webinar, please keep an eye out for our communications on upcoming MHN Voices webinars. In addition, our sister brand, Commercial Property Executive, will offer a mid-year outlook for commercial real estate on June 24th with Mark Zandi as our economist. Thank you again to all of our speakers for a fascinating discussion, and thank you all for attending today.
Thank you.
Thank you. Take care.